If you have tried to buy a home and you've been told by a bank that you don't qualify because of potentially income or you're self-employed or what have you, this video is going to provide a lot of great information that might actually give you the confidence to purchase that next home, and tons of products out there that can help you get to that finish line. So we are going to dive into some creative lending solutions with my partner here, Lauren Walton, Lending with Lauren, and let's get into it. So we were talking, Lauren, before we started to roll, but basically how we have buyers, and we've worked with buyers in the past where they potentially have talked to a bank and have been told, hey, unfortunately you're self-employed, we need more history on income and what have you. And I always direct them to you and your company because you have so many amazing out-of-the-box products, outside of the standard conventional FHA, VA loans. You have some really great creative lending solutions. So do you want to jump in and just talk about a couple of them?
Yeah, absolutely. Thank you, Nathan. So yeah, one of the things that I really pride myself on, my company, is being able to offer a lot of creative options. So I spent many, many years in mortgage at the banks, and that was kind of one of the big pitfalls, was just, things had to be very vanilla, and they really weren't willing to think outside the box. And so I love a good challenge, but really love to be able to really dive in and understand the full picture and be able to say yes to as many clients as possible. And so a lot of that comes with self-employed clients especially, and some of these creative lending solutions. So I have had many clients over the years that they'll come to me from a denial, usually from a big bank or maybe a builder, some type of smaller lending institution as well, but they won't have a path for these clients. For a lot of these self-employed clients, and if you're self-employed yourself, you probably know this, understand this, and maybe have dealt with this in the past, but qualifying them on their tax returns is really not going to be a viable option in a lot of cases. So the reason is as a self-employed business owner, you may not claim everything, right? You're gonna have some write-offs, you're gonna have depreciation. A lot of those things really hinder you when you go to purchase a home. So that's really where the hang-up comes and where the roadblock comes, is that many of those lending institutions and those banks are trying to qualify self-employed buyers on using their tax returns. Versus what we do is we look at other alternative options. So we don't even collect the tax returns at all if we know that those are going to be a challenge. If not, we could always review them first and see. But the creative alternatives that we have would be looking at a bank statement loan, a profit and loss loan, and a 1099 loan. Those are the three options. So obviously if you're 1099, you'd provide us those 1099s and we would look at those to qualify you. The profit and loss really comes into play if you've had a really good last year, for example, and that hasn't yet been reflected on your tax returns. We could look at the current year that we're in, a year-to-date profit and loss, and really be able to capture that income for that present year. And then the bank statement loan, I would say, is the most popular option. We can look at bank statements that are either business, personal, or both. So it's really wherever the business income is getting deposited into. And we can look at either 12 months or 24 months, whichever one we think are going to yield the most income. And we are going to look at every month, we're going to look at the incoming income deposit from the business, and we're going to average those over 12 or 24 months. So I have reviewed many bank statements and done bank statement loans for many clients, and this always yields significantly more income than what is on the tax returns. I have found that this is a great solution for self-employed buyers. The other thing that they tell me is that this was a lot easier for them than their tax returns that are 80, hundreds of pages, depending how long, right? And we need business returns and regular returns. And so they're like, this was just daunting. And then the tax returns are kind of torn apart, and there's a lot of other things that need to be provided. And so the bank statement loan is a lot more streamlined. It is a lot easier. And it almost, like I said, always is going to yield more income. The other nice thing is we can actually review those bank statements early on in the process. So if you are just in the house hunting phase, if you have or have not even been pre-approved yet, we could actually get those bank statements and send them for a preliminary income review, so we know exactly what we're looking at from an income perspective. So that has been a huge win for so many of my self-employed buyers, and I think many of them don't even know that this type of program exists without having, realtors that are steering them in the right direction.
And what is one con of these? Because we did talk about,
Yes.
or maybe a couple cons, but I know one major con potentially.
Yeah. So I would say the two biggest are, number one, the timeline to close. So not that it's detrimental, but we can close a conventional loan in about 14 days. We're going to need closer to about like 3 to 4 weeks for a bank statement loan. This is more of a portfolio type product, and so it requires a specialty underwrite because there is a bit more risk involved. And then the second thing would be interest rate. So you are not going to get the exact market rates that you're going to see advertised. These are going to be slightly higher for the same thing that I just mentioned, really just risk and the type of product that it is. So those are the two major things. But like I said, I think that people do find ease in the process, and or they're just happy that there is a solution in general.
And that's the biggest thing. It's, you can feel so discouraged in the process, especially
Yes.
being self-employed, that it can deter you from even starting the conversation. And these are great ways to open a door and maybe nudge it open a little bit so that we can bust that door open for you and show you that, hey, this is your new front door to your new home.
100%, 100%. And the other thing too is we can work with clients that have been self-employed for a year instead of the typical 2-year requirement. So also, the biggest thing really is reaching out and let's have a conversation about the full picture. Everyone's situation is different and unique. But I just had one recently. They've only been self-employed for 1 year, 4 months, and we're going to do a bank statement loan for them. So there are a lot of solutions out there, but just having the conversation. I was just telling Nathan a story about one of my clients that just relocated here, and we actually have what's called a no-income loan. And I know that can sound really scary and maybe a little dangerous. This particular loan, there are credit requirements that are bit higher than normal, and you also need to have 12 months of reserves. So what that means is you have to have 12 months of your full payment in a bank account or multiple bank accounts. So really what that means is that you essentially could float yourself for 12 months before you would no longer be able to afford this. So this is perfect for somebody that might be in between jobs, right? This particular client was relocating here from Knoxville, and they had not yet received their job offer for their job in Columbus. They found a property that came on the market that they loved, they wanted to have. The wife was a stay-at-home mom, they had 2 young kids, and they just knew this house was going to be perfect for them. But the big hang up, husband doesn't have a job offer yet. So they did not have the option of paying cash. They did happen to have 12 months reserves in a bank account or beyond 12 months reserves. They actually were able to do what we call a no income loan. And that was really just because they had about a 3-4 week gap in between when that job offer letter was going to be generated. So again, something that you may not think there's a solution for, or really, outside the box, we can typically find a great solution.
Yeah, and again, these are great solutions for clients who a traditional bank might seem or feel are a little bit more quote unquote risky.
Yes.
And obviously that no income loan can raise some, maybe some back hairs or neck hairs on, 2008 and when we had the whole mortgage crisis. But there are so many more, security measures in place
100%.
now for that type of product. And again, this is something that is very niche in making sure that it works for a very specific client.
And that's such a good point too. So like I had alluded to earlier, I spent many years at the bank. And so where I'm at now, we are just a mortgage company. We are not a bank. And so our appetite for risk is higher because mortgage is all we do. We're also a privately held company, so we can assess our own risk. And so that really allows us to be able to say yes to far more customers than I had ever been able to in my career prior. But we also make sure that we are being smart in making these decisions. We do unconventional, we underwrite direct to Fannie Freddie. We do not have any additional overlays. But with some of these other creative lending solutions, that's why there may be a slightly higher interest rate or our credit requirement may be a little higher because there are other risk components that we need to consider. But I think that's the biggest thing is why an appetite for risk may be different lender to lender is just if all we do is mortgage, we have to be willing to take on some more risk versus the big banks that have other ways that keep them afloat, right? Depository relationships, credit cards, things like that. I think another one we talked about a lot before we jumped on the camera here was the bridge loans.
Yes.
So
Yep.
there's a couple of different varieties of bridge loans. So one bridge loan, well, I guess first I should explain what a bridge loan is. So a bridge loan is basically bridging the equity for you from an existing home to a new home if that existing home is not going to sell before you buy the new home. So there's obviously an opportunity to make a contingent offer. That means that you are buying the new home contingent on the current home selling. Sometimes that's accepted and sometimes it's not, right? It really depends on the property and how much other competition there is or the time of the year that you're trying to buy. But contingent offers can be difficult to get accepted. And so that's really where the bridge loan product comes into play. The one bridge loan product we have, we would bridge the equity from your existing home for you to put as down payment on the new home. And then once your existing home sells, you will pay that bridge loan back. This is done in-house. It's quick, it's easy. The bridge loan can be funded in about a week. The money goes straight to title, pretty easy. And a lot of people will use that as a plan B, right? Like they get in contract non-contingent, but they try to get their house sold first. And then if that doesn't happen, they can execute their plan B bridge loan to still be able to purchase that house. So that is a really great option for a lot of our buyers. And I end up using this far more than I thought that I would. The other one we have is basically a guaranteed buyer contract. So where that's a little different from the bridge loan I previously explained, on the previous bridge loan, we would actually have to count both mortgage payments against you as the buyer because we don't know for sure that that existing home is going to sell. So we cannot put you in a position where you can't afford to make both payments. So we need to qualify you with both. The guaranteed buyer contract bridge loan would actually be a guaranteed purchase of your home. And so the way that that works is Nathan would actually have 6 months to sell your property, which is should be a good enough runway, hopefully, to make that work. But if not, it would be guaranteed to be bought out at the 6-month mark. And so that allows us to eliminate that mortgage payment. So if we're in a position where our buyer cannot qualify carrying both properties, this provides a solution to that potential problem.
Yeah, and that's, again, it's a great way to have a safety net.
Yes.
Especially when, we're in a market that if you're looking to buy and sell during the winter market, it can sometimes be a little bit slower on the sell side. So that's just a great way to give you a little bit of peace of mind
100%.
And have that security knowing that, okay, I am going to be good no matter what with that product.
Yes.
Yeah. And then I have clients that reach out all the time. I connect them with you as well that are, maybe they have their first home and they love their first home and they're looking to invest and maybe buy an investment property, or, we work directly with investors as well. What are some great options out there for investors?
Yeah, so investors is another one where you really can get creative. So, traditionally investors can qualify for normal conventional financing, and that's still a great option to entertain and to look at. After you end up getting multiple properties, it does become harder and harder based off of how the taxes are filed once again. So tax returns are kind of the, the difficult documents to overcome. But we do have some great, they're called DSCR loans. This stands for debt service coverage ratio, that are investment property specific. And so sometimes I have investor clients from the very first house they buy, they use this type of product. Others do this as they get a few in their portfolio. But the way that this loan operates is instead of the buyer qualifying on their own income, they actually qualify on the income of the property that they are buying. So they do not provide pay stubs or W-2s or tax returns. Instead, we get an income-based appraisal on the property they're buying, and that market rent will actually be utilized as income to offset the mortgage payment. If there's a lease in place, that can also be used to add some kind of favor the value that's going to be used for income. But as long as, ideally what we want is a 1-to-1 ratio, right? So the income to offset the rent at a 1-to-1 ratio. If not, you can certainly go lower. Let's say the rent is like 0.75 to 1. We can utilize that. But the best terms you're going to get is if it's a 1-to-1 ratio. But this is a great solution for investor clients. Also, my investor clients that go this route say it's so much easier than them providing their tax returns and their rent schedules and all of the history of their leases and rental agreements and all that stuff. So I think from a documentation standpoint, it's a lot easier, and it allows people to really add more and more and more to their portfolio. On DSCR, you can have up to 25 finance properties, and on conventional, the max you can have is 10.
Wow.
So as you grow those portfolios, you either have to bundle them and do like more of a bundled loan, or you have to flip to the DSCR at some point to be able to have more finance properties on your credit report. The nice thing is in the DSCR too, you can close directly in an LLC, which most investors want. Conventional does not let you do that. You have to do it after closing. But on DSCR, you can close right in the LLC, and these can close in as fast as 17 days. So you're not really looking much different. Rates are pretty comparable because on conventional, you're still getting investment rates. So they're not quite as favorable, obviously, as primary. These are the same. So there's pretty similar, when it comes to rates, there's a lot of similarities. But yes, I think, this is a great solution. solution for investor clients. And a lot of people that are already in that space understand and know this type of product, but would love to chat further, if you're interested in DSCR or any of these that we talked about. Really just me understanding the full picture allows me to figure out what the best path and the best solution is.
And one great thing about that DSCR is that you can go up to an 8-unit building,
Yes,
correct?
you're
Yeah,
exactly
as
right.
opposed to a 4-plex with
Yes.
your conventional, you can go up to an 8-plex, which is great.
Yeah,
as
and I
well.
see more and more investor clients, if inquiring about duplexes, 4-plexes, 6 units, 8 units. So I'm seeing more and more of that lately.
Yeah, so great options out there,
Yes.
especially for investor clients.
Yeah.
So if you're a buyer or an investor that needs a unique creative lending solution, you know that you need to reach out to my partner, Lauren Walton, Lending with Lauren. She is so great and will take great care of you. And if you need a great realtor to help you find that property, obviously reach out to myself, C-Bus Nathan Klein. And I and Lauren would be so happy to help you throughout the whole process, educate you, and guide you through investing or buying your first property or maybe your move-up property, whatever it is. So as always, I put videos out every Friday. Follow along, like, subscribe, and until next Friday, have a great one.